After a pretty brutal sell-off on Friday in the markets, and of course yesterday a lot of slop kind of in the markets. We were negative, positive, finished up negative for the day. It's been a rough, kind of a volatile couple of weeks. We had gotten, above 2,800, have been unable to hold that, have kind of been flirting between 2,800 and the 200-day moving average here over the last couple of days. Just really kind of consolidating here. The question is whether or not the market can get enough oomph behind it to make a run at all-time highs, which we're not that far away from. We were almost about 3,000, last year, so a couple hundred points higher from here on the S&P. Do that in a few days if the market really gets some momentum behind it. So, as we're starting to watch a lot of this economic data, we're right here at the end of the quarter, so we're about to start earnings this season again. And one of the big issues to watch here for earnings season coming up is not really what companies are going to report. Corporate earnings are going to be, they're going to be okay. They're not going to be great. And of course, one of the big risks is that in 2018, we had the benefit of tax cuts, right? So in 2017, December, the government passes tax cuts. And so we had this big cut to taxes. And what we wrote at the time is this is great. It's going to give corporations a big boost to their bottom line, but it's only good for 1 year because after the first year, this big boost to bottom line's earnings goes away because we go back to looking at earnings on a year-over-year basis. So in other words, if we earned $120 in 17 and it went to $140 in 2018, so there was a $20 increase in profit. So on a percentage basis, we go, wow, that's a big percentage increase, right? So, but going this year, we're going to look back to last year and go, okay, we're at $143 versus $140 last year. It's a $3 increase. Well, all of a sudden, it's not so exciting. So one of the things we're looking at here is this, and despite the fact that the markets didn't rally a lot on that big increase in earnings is problematic because, again, now that benefit of tax cuts is going to go away. So when we start looking at earnings, the year-over-year growth rate is going to become much more important, much more of a focal point for investors as they try to justify the valuations they're currently paying for every dollar's worth of earnings, and particularly growth. So the big issue is not going to be so much what they're reporting, but it's going to be what they talk about going forward. We still have tariffs in play. We haven't solved that issue yet. There's not, we've gotten pretty quiet as of late on what's happening with trade and trade negotiations. China's made some rumblings about potentially, again, I told you one of the big sticking points here on the show several times is that it's going to become down to this technology transfer. China's been making some rumblings about the issue on cloud computing, et cetera, and what they're willing to give or not give up in relation to that. So this whole technology IP transfer is going to be one of the real sticking points in these negotiations. So again, it's kind of gone very quiet as of late, and we haven't, there for a while we were getting daily trade alert, headlines, right? Coming off the December lows as the world was coming to an end, it seemed to like all of a sudden it was every day from the White House, we're getting close to a trade negotiation, we're getting close to trade. Every day we were hearing something, and of course that was helping giving the market a little bit of lift, hoping we were going to get a deal done. Well, now that the markets are kind of recovered a bit, all of a sudden that's gone quiet. And we're now approaching the end of the month where we were supposed to have a trade deal come into focus, and we haven't heard a whole lot about that. So again, that could become an issue in the next quarter if we don't start to see some movement on trade. That could start to weigh on outlooks for companies, and particularly again as we talk about going into earnings season, it's not going to be so much what companies report. It's really going to be about what they say going forward. Talking about the future, what they expect their growth to look like. That's really going to be where investors are heavily focusing their attention. Over the course of the fourth quarter, of course, we had fairly weak economic growth. That number is being revised down as we speak. So the total growth from quarter four to quarter four of 2018 is going to be revised down to below 3%. So that's kind of in line with what we've been kind of running in this country really for the last 6-7 years. We've been running just above this kind of 2.5% rate of growth. So this year, the first quarter of this year, fairly weak, as we've seen a lot of economic data come in much weaker than expected. A lot of this had to do with a tremendous amount of cold weather. We had lots of blizzards and et cetera really kind of occurring
through that first quarter that really suppressed a lot of activity. So not surprisingly, we're going to start to see a bounce in some economic activity. Some of these indicators should start kind of perking back up here in the next couple of weeks. Now, what will be important, though, is exactly the strength of that rebound. The issue is not really that we get a rebound. The question is the strength of that rebound. And it's been very interesting. Over the course of the last really decade, we've had a very unusual environment in terms of economic data. We look back over the course of the last year, last 10 years, and we say, wow, we've had this just kind of this string of economic growth, which has been really interesting because there were periods where we were very close to basically going back into a recessionary drag. But in 2011, as an example, 2011, economic growth was slowing down dramatically. We were looking at a lot of risks. Of course, we were talking about the 2011 debt default at that point. Remember that whole issue with the federal government? Well, at that same time, Japan was hit by this massive economic crisis. They had a tsunami that was joined with an earthquake, and then basically had a nuclear disaster. Godzilla came walking around, and of course we'd shut down, the entire auto manufacturing facilities over the course of several months. Really impacted the manufacturing component of the economy. The economy slowed down dramatically, but the rebuilding of all that, as Japan got back up online, there was this big surge of pent-up demand that boosted economic growth, particularly in the auto sector, and kept the economy going forward. Then, fast forward, 2012, we start to slow down here a bit again. 2013, we're slowing down, worried about the fiscal cliff. And of course, that was where, of course, we launched QE3 with Ben Bernanke. That provided a lot of lift to the economy. But we also had Hurricane Sandy. Hurricane Sandy, of course, billions of dollars from the federal government put into work rebuilding stuff. And then fast forward again to 2017, economies beginning to show some signs of weakness. We have 3 major hurricanes, 2 major wildfires, and a partridge in a pear tree, and we had about $150 billion worth of stimulus from the federal government put into the economy. So here we are again, looking at very weak economic growth in the fourth quarter and the first quarter. Guess what we've got going on right now? Massive flooding in the Midwest that is going to basically potentially be some of the biggest displacement of individuals that we've seen in the last decade. Tremendous amount of economic damage that potentially will arise from this. But keep a watch on what's happening in the Midwest. This flooding could impact as many as 200 million people. That's amazing. But again, it's going to require a lot of government stimulus, a lot of government funding to help bail that out and, of course, get rebuilding done. That could give a little bit of a temporary boost to the economy, kind of sustain this cycle for a little bit longer. But again, it's been interesting that it's almost as if the government's had Mother Nature on speed dial. Every time we get into a little bit of trouble, whip up a quick disaster. Of course. Excuse me. Of course, I've also seen all the movies where the government's been playing with the weather. So I don't know. Maybe it's one or the other. but that new movie out with Gerard Butler called Geostorm. There you go. Maybe they did figure that out. Truth is stranger than fiction, right? But anyway, let's take a quick look at the markets here. We kind of get the day under the way. We've had a couple of days of sell-off here, and the markets are sitting on pretty important support. Importantly, keep a watch on what's happening with the 50 and the 200-day moving average, because we are very close to crossing that 50, 200-day moving average back above into positive territory. That's actually bullish for stocks. I've got an article out today talking about, will the markets go back to all-time highs? Will we see new highs? And the answer is probably yes. We've got enough stimulus in the markets right now still, even with the Federal Reserve. They're still not draining a lot of liquidity out of the market. Of course, the recent decision not to hike rates anymore, of course, giving also some additional support to the markets. But despite the fact we are seeing slower economic growth and starting to see some issues with corporate profitability, there is enough momentum in the markets right now to potentially at least get these markets back to all-time highs or close to them. That's what the article goes through today. But again, don't get into the idea that, oh well, that's great, we're just going to keep going on forever. This market's behaving very much like we've seen at previous bull market tops back in 2008 as well as in 2000. Lots of similarities economically, lots of similarities momentum-wise, price-wise, kind of what's happening in the overall markets. But again, kind of watch this, what's happening with the markets currently, because again, this is going to kind of be important over the course of the next few weeks. More importantly, we're also getting oversold here on a short-term basis. We've had a lot of selling here over the last few days, And that pullback here last Friday and then again on Monday really pulled a lot of the momentum out of the markets, at least temporarily. We are getting back to oversold. One of the concerns here, though, is that the market's really been supported by three sectors: technology, utilities, and real estate. Those have really been the big supporting, and staples, I should say, throw that in there, staples as well. Those four sectors have really been the support of the market. Really, most of the other sectors have been negative and dragging on the overall markets, but those four sectors have gotten really extended and very far overbought. So again, if you've got money in those sectors, take a little bit of profit out here and look to rebalance some risk in your portfolio. But the real risk to this market is if those sectors begin to falter, because this market advance has become very narrow, and that's typically a kind of a late stage sign of a rally. So again, kind of watch this, what's happening. We'll keep you up to date. Get by the website, realinvestmentadvice.com. The latest blog post is out. It's called Technically Speaking, Are We Going to Go to New Highs? Answering an email question that we got the other day. That's on the website now, realinvestmentadvice.com. And of course, also while you're there, check out all of our podcasts, our YouTubes. The YouTube channel is right there as well on the top of the website. And of course, got lots of great interviews and some great ones coming up here in the next few days as well. So stay tuned. If you subscribe to our YouTube channel, we'll email you every time we put out a new podcast. So we'd love to have you watch.
Baby.